Welcome back to another episode of the Property Management Success Podcast. Today, I'm excited to have Taylor Ho on the podcast. Taylor, how are you?
Doing well. Thanks for having me, Tony.
Great to have you on. I noticed the signature cowboy hat, and we're going to talk about some things really deep. But I want to get the story. I've heard it a little bit before, but where's the cowboy hat come from?
Yeah, so I was born and raised here in Texas. And, I kind of see it as like, you end up going to all these conferences, all these places, and you look across a room and everyone, I wouldn't say looks the same, but it's hard to distinguish anyone from a, massive crowd. And so I always thought having a cowboy hat or something to uniquely identify me was this like, I wouldn't call it a branding thing, but it was always a good thing. And ever since the first time I put one on, it kind of stuck. It's so easy to say, especially going into a big conference, whatever, like, oh, just look for the Asian dude in a cowboy hat. Like being able to just do that, we do this as founders, but like we'll blast, like pre-conference, we'll send things to like attendees. And I'll always put something like, hey, PS, whether we can meet or not officially, like come find, if you happen to see, the Asian dude in a cowboy hat, come say hi. And I can't tell you how many times like random people would just be like, like they're like Asian dude cowboy hat. And it's like clearly that works. Now, whether or not we end up doing business, whatever that, like that's kind of, tertiary to it, but it's like this works, right? Things like this absolutely work. Second Nature with their purple branding,
For
Pest
sure.
Share with their, the orange sneakers, like those kinds of things absolutely work.
Yeah, I think you have to find a way to stand out. I don't know if you are familiar. I'm sure you're with the reticular activating system, where our mind, everything is the same. All property management companies are the same until we're different. And what makes us different is the messaging that we put out there, that our uniqueness in the marketplace. And that's one of the things I've always noticed about you is you do stand out in the marketplace. And now that you have their attention, what are you going to do with it? And that's one of the things that I think is really interesting is what you've been able to find out about management companies and what makes them tick and their inner workings. And so I want to go back and talk a little bit about your background of how you got into the property management space. And then I also want to let people know that you've got some credibility in this space. And so kind of talk about, as we were talking a little bit when we were just setting up the show, that you also are still running a management company where you've done those roll ups. And so I want to dig into that and talk a little bit about that. So how did you get started in the property management space?
Yeah. Well, uh, I don't know how many people know this about me, but I actually grew up in this space. So my dad was the property manager realtor. My mom was a CPA accountant. And so quite literally back when, as early as I can remember, I would sit in my dad's Toyota pickup and he'd drive around in Houston and knock on doors to collect rent. I remember as a teenager in middle and high school, like we live in Houston, so it's really hot. But regardless, we would go climb up into attics in rental properties to replace hot water heaters. And I don't know if any of you guys have actually had to lug a 200-pound hot water heater down from a third floor attic, like at like 140 to 50 degrees inside the attic. But like I've done that more times than I can count. So quite literally, I grew up in this space. But after college, for me, it was UT at Austin. There's a small company at the time that just so happened to be recruiting there, and it was called Appfolio. So my first job out of college was customer success at Appfolio, where effectively that was my first like professional experience in the industry. I became a product expert, supported, if you were a customer of Appfolio's back in like 2011, 2012, you probably have emails from me because I supported thousands of customers at that time. And then I'll fast forward to I joined a friend's company or startup after I did a startup, went to the Valley, raised money and all that kind of stuff. Went through tech people know this. It's 500 startups in the Valley. I joined a friend's startup called Dynasty. They're famous for Lisa and now Liam, and they were acquired by none other than Appfolio. So they were doing essentially leasing and maintenance automation before generative AI and LLMs today. So that was back in 2016, 2017. That brought me back into property management. And while I was at that company, Dynasty, we realized, or I realized, like there's this huge problem still in the industry, which is most property managers do not understand accounting. And so I set out to fundamentally solve that problem. And so I'm the founder of APM Help. So that's Apple Paul Mary HELP.com, where really the name is, it was supposed to be kind of similar to PM Success. We were trying to help property managers, just PM Help. And back then, this was back, Yellow Pages kind of time. There was a Facebook group that we were part of where they had a alphabetical order list of consultants. And so I was like, well, PM Help, right? Tony, you probably have seen this, but it's like PM Help is like down at the bottom of the list, right? Like, how do I get to the top? So I was like, well, let's just stick an A in front of it. And so hence APM Help was born. That was the branding or the name. It doesn't mean anything to anyone outside of the industry. And now I think we've done decently well in that, like, when you think trust compliance, when you think property management, bookkeeping or accounting, or at least if you're getting audited, people at least now know, or at least, ChatGPT and Gemini know APM Help is probably one of the best firms to help you, go through one of those.
I want to dive into that a little bit because you have some insight into the property management industry that most people don't have simply because of your access to their data. And one of the things you mentioned early on is door count really is irrelevant when it comes to profitability.
Correct.
And that I think that's something that when you've been in the business for a while, you come to understand that. But it is a big brag. People beat on their chest and talk about how many doors they have, or if somebody has fewer doors than that, they feel like maybe they're less than because, well, I'm talking to somebody that has 400 doors and I have 200 doors, or they have 1,000 and I have 600. Whatever it is, it feels like I'm maybe not at their same level simply because they have a bigger door count. But you actually get to see the metrics of what really makes sense for companies when it comes to being successful. What are some of the insights that you gain from having access to that data?
Yeah. Fundamentally, I would tell you the number one biggest differentiator when it comes to profitability and this is like primarily like, let's say sub even 5,000 units, okay, in residential property management is overhead. Right? At the end of the day, I've seen plenty of sub 200 unit, and I don't want to say like primarily single family, for all intents and purposes right now, scattered site, single family, small multifamily property managers, okay? The most profitable ones are the ones with very low overhead. And what do I mean by overhead? I mean, essentially, there's no middle management. It's effectively the business owner who is typically the broker, the licensed broker, and in charge of sales or BD, business development. And then you've got their operations team that's actually managing the properties. Okay. Those at that size or at a certain size, those are very, very profitable. I've seen plenty of them reach 20, maybe even 25% EBITDA margins or net income, or some in our industry will call it seller's discretionary earnings and things like that. But effectively, like, what is the cash flow that it's spitting out? Those tend to be very, very profitable. And what you'll see is as you get bigger, inevitably with doors, you just don't have time or you need more people to be in more places. And so you start hiring people who are less utilized, but inevitably, as humans, we really can only manage a certain number of people. And once you get beyond that, you have to hire more managers. And as you start stacking managers or layers, your profitability goes down effectively to like nothing, if not negative. And I'll give you and I've done this multiple times, but I'll give you very clean examples or like numbers. You would think $1 million business is successful, right? Could be successful. It's not like you're a millionaire, arguably, if the thing traded at 1 times, annual like revenue. $1 million business in our industry is barely doing $100,000 in profit. Let's just say, and it doesn't sound like a lot, right? But it's like, that's 10%. NARPOM has put out plenty of annual reports that say the average profitability of a management company is sub 10%. So $1 million revenue management company is doing, and I'm going to just say, $100,000. Well, what do you think happens the second you have to promote someone or hire one more person who is not that utilized? I don't know where you are, Tony. I can tell you where I am, but the typical person Bare minimum, where even in Houston, that's remotely good and has some staying power, is going to be $60,000. That's not even including benefits, potential turnover, training, anything like that. Just straight up $60,000 all in. That person can cost you probably 100 grand. So your $100,000 gross doing net 10% business on $1 million in revenue. Once you hire that person, now that business is doing zero, right? And a lot of people, just like you said, chase unit count. You know how hard it is to go from doing 10% and 100,000 in profit on a management company, relatively small management company, right? To getting back to the same profitability with over, let's say 500 units. Once you add more units, you add way more problems. And the biggest things you add middle management or overhead. And as you add that overhead that's not actually producing revenue, you'll find that it is stupidly hard to get back to sustainable, consistent profit.
I think most people realize that when you add somebody, you effectively you get to a breaking point and you say, okay, I need to add somebody, and let's use your figure of $60,000. You're adding that, but you're stair stepping. You are immediately adding that all at once. So even though if you're hiring somebody to help you with business development or operations or accounting or
Accounting or
whatever,
maintenance coordination,
maintenance,
anything.
anything,
Exactly.
you stair step it. You immediately have that expense without necessarily generating the income at the same time to be able to cover that. And so property management companies and all businesses, but specifically ours, they go through this cycle where you start to have a little bit more cash, and so you decide to hire somebody, then you have no cash flow. Then you have a little bit more cash flow, then you have no cash flow because your expenses stair step where your income increases gradually. And I think that a lot of times people are afraid then to grow because, well, I need help, but I can't get help because it will mess up my cash flow. And if it messes up my cash flow, then either I don't get to take home any money or something else bad happens. And so they wind up saying stuck in the business where instead of acting like a founder, instead of acting like the visionary, the one that's keeping their head up and looking at where the business is going 6 months from now or 3 years from now, they're in the weeds. They're driving around putting lock boxes on properties or whatever it is because they're afraid to pull the trigger to hire somebody. And I know you have a solution for some of this that I think we're going to talk about in a little bit, but I want to stay just really quick. Any other insights that you see about management companies? I do have one question about that as far as structure. So, are you seeing companies being more profitable on the portfolio side, departmental side, pod side? Was there any takeaway? Was there any consistencies depending on the way they've structured their company?
I wouldn't say there's consistencies across how they're structured. I've seen pod structures, I've seen department structures. They all work decently well because they're all very specific to maybe your market and how your market's working. Um, Again, at the end of the day, it's when you add that like GM or like when the founder no longer is the founder operating anymore, and you bring someone in. That's typically the biggest like change when it comes to profitability and cash flow, regardless of if you're a department structure, a pod structure, a team structure, whatever those structures may be. Because a lot of times what you end up finding is in those structures, let's just talk about a pod structure, right? Like they're essentially like I won't call it regulating, but like a self-operating unit. And as long as you don't have an extra manager in between and they report to you as the founder or the business owner, all of their performance effectively flows up to you. But once you stack that individual manager in between, that manager is taking all of it effectively. And a lot of times I've seen the founders and business owners, they're now shoveling money to go support those managers or the COO that they bring in because they hope and pray that again you can grow or they can grow the business by double in a year or whatever it may be. When historically the only person that's successfully been able to do that was you, the founder, because there's just so much that a founder ends up doing. It's very hard to hire somebody to care as much as you do. Now, Tony, you did mention like what is something else that I've seen. honestly, and this is an I don't want to make this a shameless plug, but like there's a huge difference between a PM operator that actually understands the financials of their business versus ones that don't. Like I've seen plenty that have 100 units that understand everything financially about the performance of their business versus someone at 500 doors who still doesn't actually understands that, like they're actually, there's a leaky bucket when it comes to reimbursements, right? Where they're fronting money for their owners and not actually getting money back. And it all comes back down to clean and timely financials, right? Both on the company side, but then also on the property, like technically the PM side of the trust side.
I think that's a really important point to hit at. Most of the people that I talk to that get into property management, they they don't set out to have this as a career path. Something they step in it like quicksand, and something sucks them in. And they come from a few different backgrounds. One is they're an investor themselves, and so they can't find anybody that can manage their property as good as they can, so they decide to start a firm. Another one is they're in real estate sales, and I've already have a license, and so market's good or market's bad, doesn't really matter. Something says, hey, I can use my license to also manage property. Client wants to buy an investment property, but they don't want to manage it. So the agent says, well, I'll figure it out. And all of a sudden they start to build this portfolio of managed clients, and they say, well, I guess I better get legit with this. And they start. Very, very few people that I talk to come to property management with any sort of financial background. And so they're doing the best they can, but they've never really been taught, number one, how to actually go about running a profitable business or managing books properly or doing their three-way reconciliation. And so there's so many things on the money side that can get you screwed up and take your business down, even if you have the best operations, even if you have the best ability to go out and sell. And so I think helping people figure out and identify, am I not the right one to be doing my finances? Like how do you, and I know I'm really interested in the next product that you have, and I want to talk about the fact that you actually still, as we mentioned, are not just a property management vendor, but also a property management company where you've bought, sold, gone through acquisitions, and so I want to touch on some of your insights from that. But if somebody's listening to this and they're thinking, I do hustle hard, I put in effort, and at the end of the month or the end of the quarter or the end of the year, I'm looking at and I'm like, I don't know where the money went. I don't know how to like be different next year than I was this year. What do you say to them? Is this something that you help them with? Do you help them with the insights, or is it just we give you the reports to get your own insight? Like what's that look like?
Yeah. So at least with APM help, we are not your like coach per se, right? Like unfortunately, we're too busy just cleaning up PM companies and from a financials, like an accounting standpoint, and helping them understand like, here's what your property's financials actually look like, the ones that you manage, let alone actually diving deep and getting into their corporate books. I think it's, I'll come back to this, which is you asked like, well, how does one realize or understand like maybe I'm not the right person, but also maybe the person that's doing it today in my business isn't also the right person either. Because, unfortunately in our industry, and I think you danced around this. You were being very nice to our industry, but like we have a lot of accidental property managers in our industry. And it's not like, I'm not saying that out of like, it's like, oh, it's all your fault. Like, you shouldn't be. No, no, no. It's like, look, realistically, like they were real estate brokers first, and they had, they did very well in the most recent up when it came to the real estate market, and they had lots of investor clients. And we all know the dynamics between like, well, do you really want to refer your investor client to a competitor that happens to do property management, but is also a licensed broker? Probably not. So you end up saying, just like you said, I'll figure it out. Pay me 10%, I'll figure it out. Well, in that situation, you've got to figure out a bunch of stuff, but let's just focus on the accounting side. First off, if you don't even know what a bank reconciliation is, or You don't even know the difference between an income statement and a balance sheet. Let me ask you a very simple question. Do you think you're the right person to identify or train the bookkeeper that is doing that work for your company and your clients? Right? So like, unfortunately, it's like in our industry, we have accidental property managers who get into the business. They kind of, do the accounting based on like knowledge-based articles and, oh, it's easy. You hear the property managers, all of them say, oh, it's easy. You don't need an accountant or a CPA to do this. And then they grow, right? And that's fantastic because they're great at sales. They hustle. But then they're like, oh, but I can't keep doing the like entering checks and paying bills and things like this. But it's so easy, right? Let me just hire somebody to do it. And then they come in and you train them. It's like, I hate to say this, like literally like the blind leading the blind to do something that is the one thing that actually can take your business down overnight. Like that's the one risk. If you're in a regulated, like your state has a real estate, what's it called? Like a real estate board, the Department of Real Estate, Department of Licensing, something like that. That's the one thing where if you fail a trust compliance audit or a review, they absolutely can revoke your license and shut you down. And so again, just I would come back to some of the best PM companies I know, right, that we've seen, small or large. They at least know what's going on with their books in a timely fashion, right? They're reconciled within the first week, which I understand it's rent week. That's the busiest week of a PM company, but they have someone dedicated to make sure their books are reconciled. And then secondly, similarly, their corporate books are done before the 15th of the following month, right? Like all of us who've been business owners, like you tend to want to say we operate like logically, we operate based on objective measurements and financial performance. Well, if you're not even doing corporate books, how can you make any logical decision for your business without data, without actual data like that's like real? Otherwise, we're all just going off of feeling. And going off of feeling only gets you so far until everything comes crashing down and you're just going to be pulling your hair out like, what is going on? I thought we grew, 20 units last month. How are we still missing payroll or not having enough cash in the bank to make payroll? And shameless thing, I'm going to do this. Whatever you do not borrow money from your trust accounts. Whatever you do not do that.
I
Okay.
don't think that's necessarily a shameless plug. I think that's trying to keep people out of jail. You know?
No, fair. But but people like Tony, I shit you not, people do this all the time. And they think, oh, I'm just going to do it once and I'll get the money back next week because, all the ranks come in, we can pay ourselves. Like, and I get it, right? Because when I was growing my business, if you're on not the bi-monthly payroll, but you're on the every 2 weeks, you're going to have 2 months out of every year where you have 3 payrolls in a month. I know that feeling. And when that happens and you didn't get paid your management fees because that third payroll is that weird 1 week left in that last month, you're going to feel that pinch and you're going to look at the security deposit account and be like, well, there's $500,000 there. And it's not like all my tenants going to move out. So let me just borrow the 20,000 from there and I'll pay it back the next week. Whatever you do not do that because one, that is illegal. And two, if the regulators ever find out, it doesn't matter that you gave the money back. The fact that you took it in the first place is already jail time.
Right.
Like,
Yeah, it's not your
just
money.
don't. It's not your
It's in
money.
your
You
account.
cannot use it.
It's in
Yeah,
your account, but it's not your money. So Marsha Waters is the director for the Colorado Real Estate Commission under the Division of Regulatory Agencies here in Colorado. And this has been a few years now, but she came in and spoke to our local NARPM chapter when I was the president. And we had a discussion. She did a presentation, and then we had a separate private conversation. And she told me that over 75% of the licenses that are revoked in the state of Colorado are revoked because of property management, and the majority of those are revoked because of mishandling trust accounts. And so it's not only illegal and bad practice, but it's the thing that they look for. So it's not like you're going
that's
to
correct.
slide under the radar. The real estate commission knows that this is what people do. It's a large amount of money. Business owners get in a situation, they don't know what to do to make that payroll. and they think that they're going to be able to use those trust funds that are not their money. They are entrusted with those funds to properly manage those funds. But so that's one thing. That's one reason why you really need to know not just where those funds are, but doing that triple tie, the reconciliation to be able to tie those out. Make sure all the funds that are supposed to be there for the landlord are there for the landlord, supposed to be there for the tenant. The other thing I think that people get in trouble with is not just mismanaging it or borrowing, but it's when they turn over the authority to manage those funds to somebody else. They don't necessarily you can delegate, but you're still responsible for what needs to be in those accounts. And
That's
the
correct.
embezzlement that happens, I know a lot of people in this space that big names that have been burned, and they now have better practices because you don't need to be burned twice. But a lot of people that have entrusted somebody, their local bookkeeper or somebody on their team, and they wind up being short tens or even hundreds of thousands of dollars.
That's correct.
So
And I'm happy to give very specific examples of how this happens so that people, again, this is not a, a sale. I'm just giving you experience of what we've seen. So anytime you're collecting cashier's checks, money orders, or cash, right? There are many, many places that are willing to cash those and they don't have to be banks, right? Because they're effectively certified funds. So, for example, if you live close to or near casinos will cash those or issue markers against them. And we had multiple, unfortunately, very specific examples with clients where either they were going to be acquired or whatever it is, and all of a sudden they're like, wait, we're missing like $500,000. How's this possible? And it literally happens all the time. So one of the easiest things you can do is never have one person responsible for everything about money at your company. If someone is the one collecting the money, so literally like, collecting checks, collecting money orders, things like that, don't make them the ones who go deposit the money. Or let's just say you have, like, because there's plenty of PMs that have like a central office and maybe they have satellites or they have like apartment complexes and they have on-site managers that collect the money. If they're collecting and it's hard for you to deposit and they go and mobile deposit it, make sure they're not the ones responsible for reconciling. Like just always have quote unquote a separation of duties so that there's a second look on money. Like you always want that. We've seen way too many times where it's like just like you said, the business owner, the broker, the licensed property manager comes in, they build the business up. I'm too busy focused on sales and bringing new clients and whatever it may be. I hired a bookkeeper and they because they're not bookkeepers or accountants themselves, they're like, oh, just it's easy, you go handle it. And I've seen this. Actually, there's a client of ours in Colorado where we actually helped. We went all the way to the attorney general, and eventually we're able to recoup the money. But it was the bookkeeper that was there for like 15 years that every year would siphon off like 5K, 10K, right? And it doesn't have to be a lot, but over 15 years, it ends up being a lot of money. And just like you said, who ends up actually at fault or who's the one who gets left holding the like short end of the stick? It's the licensed broker. Yes, you can say all you want. Oh, I've got E&O insurance. I've got whatever insurance. E&O is errors and omissions. That doesn't cover fraud or like theft from your own employees. That covers your mistakes, but not necessarily like someone who's doing some kind of criminal thing. So just be very, very careful about those kinds of things. Reconcile your books. Please reconcile. I would say 99% of the time when we come in and we look at somebody and they haven't reconciled for a year and they ask us like, how did this happen? It's like, come on, you haven't reconciled. How? No, of course you wouldn't know that you were missing 20,000, 40,000, $500,000 because you're not reconciling, right? You don't even know that you're missing money. So
I, I certainly am not trying to throw anybody under the bus, but I've had private conversations with people that reach out to me for coaching services because their business is in a mess. And some of these clients we just can't take on because they're to the point where they need that deep forensic accounting help. But I have spoke with business owners that have been in this property management space and have not reconciled their books for not just a year, but multiple years. And when it gets to that point, I understand why they wouldn't do it because it's sort of like maybe a hoarder. It's like I understand why they don't throw their stuff away anymore because it becomes such a big issue to overcome that they just give up on trying to do that. And I can't imagine the pressure and the stress that people feel when in that situation. So
Yeah. I just yeah, and to your point there, right? Like just because APM Help, for example, or competing firms like us exist, doesn't mean we can help you solve a $500,000 shortage. Like we can't just magically make money poof, appear, right? And beyond that, I should say this, switching software does not solve your shortage either. Okay. I can't tell you how many times, Tony, where someone's like, oh, it's all Appfolio's fault. Like it's like Appfolio's fault because I haven't reconciled it. It's Appfolio's fault. So let me switch to Rentvine and all of my money problems will miraculously be resolved. I'm sorry. That's not the solution.
you mean
Like
you can't just switch software and like zero it out and start at a new balance and like let's start over. Let's start from scratch. Yeah.
that is not a solution. Yeah, like every time someone comes to us and it's like, yeah, we're considering switching, or we're going to switch, right, to from whatever propertyware to Appfolio because we haven't reconciled, right, or because we just haven't figured it out. I'm just like, you don't understand. You haven't what somehow tells you that you're going to figure out the new software and how to use that. If you haven't had the good practice, like I don't want to say once a hoarder, forever a hoarder, but you have to break that cycle, get the books clean, and then at that point, if you still want to switch, fine. But at least now you're not switching on false pretenses of, oh, miraculously switching software is going to solve my money problems.
Yeah.
Yeah.
All right, I want to switch gears just a little bit because I want to make sure we cover the other two topics that I really am interested in talking to you about. So you have this insight where you've been able to see inside of other property management companies from a financial level, and then you also built a property management company. So tell me a little bit about that, kind of where you are now, how it came to be, what it is, and maybe some insights you have there. And then I really want to make sure we leave time to talk about what you have going on at Fixed because I think that's really fascinating as well.
Yeah. So so I don't want to call it a roll up, but realistically, like roll ups have a bad connotation, private equity roll ups and things like that. But at the end of the day, um, I did not build a property management company from scratch. Okay. So for all of you guys out there hustling, going from one property to like 150, you have my respect. Okay. I would argue that is the hardest part. But what I did was I came in, or not came in, but like as APM Help, we come across many, many, many property management companies all over America who at different stages and different times and things like that. And the first one that I ended up acquiring, effectively the owner was told, hey, they've got like 6 months to live. And so that was one where it was in 85 miles east of Portland in a small little town called the Dalles, right? Gorgeous place in the Columbia River Gorge, but it's also kind of out there, right? The epitome example of like small town USA, right? 15,000 residents. And this company had about 400 units under management. And so as APM Help, because we had seen this cycle happen over and over again, where, small community property manager, they end up going and having no one to sell to, right? And so they sell to like, their competitor broker that's been competing with them for 15 years, right? And that broker, they're buying the business not because they're like, oh, I want to be a property manager. They're buying it typically because it's like, oh, I have 400 more homes to sell. And if it's a small town, there's less competition, things like that. And so they come in, and what ends up happening? Well, what ends up happening is they see $500,000 sitting in the security deposit bank account, and they're like, "Ooh, they don't understand that that's other people's money," so they just start borrowing from it, or they literally go buy a boat with that money. So we kept seeing that happen. I wanted to break the cycle. Our mission and my personal mission forever now has always been we want to clean up the industry and hopefully make it better. So we kept seeing that happen. We went out to our clients in Oregon and asked them, hey, we have this other client that really needs like ultimately a sale. We'd love to help broker something. We're not going to take anything, right? We just want to help them. right? And pretty much nobody, right? And I understand this because it's in the middle of nowhere, but it's like nobody was like, oh yeah, I want to drive 3 hours to go manage homes in another town, right? Like that just didn't happen. So I did literally what I would think the hardest thing because I'm based in Houston. So we were like, well, what if we tried this? What if we bought this thing and we tried to stabilize it and we at least know because we're the accountants, like we're not going to screw the community because whenever that happens and the security deposit, goes from 500,000 to zero or 50,000 left, the people who inevitably get hurt are the residents and the landlords in the local community. So that's what we did. So my first acquisition was April of 2019, 400 units. Today it's stabilized to, I think it's a little over 300 units, right? There was like one big owner of like 80 some odd units and he eventually like took it back in house. But like ultimately we stabilized that thing. We've kept everybody on the team that wanted to stay or who didn't want to retire effectively. And we've had it for now over 6 years. And that was stupidly hard. I'm relatively young. I thought it'd be easy, but I can tell you right now, like doing essentially a day just to get there because there is thank goodness a direct flight from Houston to Portland. I take that flight and then it's a 3 hour drive from Portland to the Dalles. And then, so you waste a whole day just to get there. So I'd leave on, let's say, a Sunday night or a Monday, spend the Tuesday through Thursday, and then take the either Thursday night or Friday to come back to Houston. I did that for 6 months straight, pretty much every other week, working to stabilize that company. We finally did it. We stabilized it. I then did another acquisition in Denver. So actually in your in your town. Maybe you actually maybe have heard of the company name, but it was called Woodruff.
Oh,
Uh,
yeah.
yeah, so it was
Yep.
Woodruff. And it was this interesting situation where he became a client of APM's and out of the blue after we cleaned everything up, we thought everything was on the up and up. He gets a letter from none other than the Department of Real Estate, DORA in Colorado, saying, "Hey, we've reviewed everything. We didn't know he was already on a suspended license and had gone through this before, but essentially they were like, you have until Sunday to shut everything down because we're revoking your license." And I found out about that on Thursday. And so we had essentially a meeting on Friday. I was like, look, I can try. We can try to come up with something, but there's no way we can get this done on a weekend. But I landed on Monday. We got an extension and we closed on Wednesday. And that business, when I got it, it was a little over 200 units. Today, it's still a little over 200 units. Four brokers, right? Like they all, Denver's big, so it's kind of spaced out, scattered site, right? And that one we've had for now over 3 years, and we stabilized it. It's clean. Everything's been on the up and up ever since, right? But those are these are very, very, very difficult, and I can tell you right now, they are not very profitable because on like individual market level, we operate them at around 15% margins. But I still have to have a manager that oversees all the markets. Well, that manager is not cheap. That manager is like 200 grand a year. So, like today we have like four markets, but out of the four markets, we maybe generate like 80K a market, right? So like at the end of the day, we're not making a crap load of money here. We're doing it because we really just wanted to save those companies, save the communities that they operate in. And if we can find a great operator in that community that we can then sell to, we'll try to do that. And that's actually one of the things that, we're now working on for one of the ones that we've acquired. We stabilized it. We found a great operator and we're like, look, honestly, we're not the best ones to operate these things because we're based in Houston or my team's fully remote. We're not actually in your community. So now that it's stabilized, it's good practices, good team, everything like that, good processes. We'd love to obviously broker something to then, give it back to the community.
Sure. So you
Yeah.
you've now done that a handful of times. I think you mentioned you're up over around 1,000 doors, and so you've got the experience looking into the industry from all of the other property management companies you saw into from APM Help. Then you got to see what it's like to actually run these property management companies inside of these communities, and you got to see inside different communities. So it wasn't just this is what works here because I'm a genius. I cracked this one market. No, you got to actually see how it's different in each market,
That's
and
correct.
um, and so
And
you got
Tony, it's completely different from Denver, which is a sprawling metropolitan area, to a small town where literally like it's 1 square mile, like not even, right? Like everyone can, armchair warrior, like, oh no, the pod structure is best, or oh no, it has to be this way. It's like, no, sorry, until you've done this in multiple different markets, I'm sorry, you're an armchair warrior. You just don't
Right.
know.
Yeah.
Yeah,
Yeah. And there's pros and cons to each one of those structures. And so it's not just take this structure and apply it. It's tell me what's going on in your market, what's going on in your company, what are your overall goals, and then you can figure out which one of those structures work best.
that's right.
Well, Taylor, I know so you have the experience, like I said, of seeing inside other management companies, running your own, and then you said there's still this hole in this marketplace that I've identified, and I want you to share with us a little bit about what you're doing at Fixed because we've talked a lot about money in this episode. We've talked about how people get behind, how money affects your mental and your stress level. And so tell me what you're doing over there at Fixed and how that helps the typical property management entrepreneur with running their business and operating at a high level.
Absolutely. And just for clarity purposes, it's FYXED.com. And this is 100% born out of the problems we saw as the accountants for property managers. Okay. Because remember, as bookkeepers and accountants, we can bookkeep, we can book transactions, we can keep those records clean and timely and accurate. But what we can't do is we couldn't solve when inevitably a rental property's had a tenant in there for 5 years and they've now given notice. And although that tenant has been there for 5 years, the property's been under the same management and ownership for over 10 years. Maybe when this, tenant moved in 5 years ago, not much was really done, like it was a good time, let's say, so they just moved in. Well, now in today's market, when they're moving out and you finally get eyes on that property, you realize, oh, this thing's more than 10 years old, right? For us to actually be able to get the comps or the market rent that the market is saying, right, we've got to put in probably $20,000, $30,000 into this thing. Or let's just say the more typical situation, a tenant is about to move out. You go in there and you're like, holy crap, they've destroyed the place. They've got young kids. They got to repaint the walls. They had dogs, right? The carpet's disgusting. So instead of replacing the carpet, let's upgrade it and replace it with LVP now and things like that. So point is rental properties need money. They need money all the time. But it's not like investors or especially these accidental landlords, it's not like they say, oh, I'm going to budget 1% of the property value towards maintenance and upkeep or repair. And like they like escrow that money. So it's like, sitting in an account somewhere. Like that's not how, rentals or property management works. Like you mentally budget it, but typically it's deployed in the market. Let's say it's sitting on QQQ or SPY, or like you say you budget it and you're like, oh, I'm good for it, but it's not like you're liquid. So if the property manager calls you, is like, hey, Tony, sorry, very bad news, but like your HVAC went out, it's not covered by insurance. I'm gonna need $20,000 tomorrow, because if I don't get that $20,000, your tenant is, because we're in Houston, let's say it's 100 degrees. Your tenant's going to, not only sue you and make matters worse, but they now also need a replacement of Airbnb or hotel and all that coverage as well. So I need $20,000 tomorrow. Yes or no? Right? Like how many times has that happened? And how many times has the owner been like, crap, I don't have that. Or, oh, I can get it to you, but like I need like 2 weeks. And so that we've seen all too many times. And a lot of property managers will be like, oh, well, we'll cover it for them. And whenever I hear that, I'm like, how are you covering it for them? And they're like, oh, well, there's just money sitting in the bank account. I can just borrow from that. And I know Tony's good for it. He's been a landlord of mine for 10 years. Again, you just did something illegal. You just borrowed money from your trust account, security deposits with other owners to quote unquote lend to another owner without anybody's permission or approval. You can't do that. You can If you're individually wealthy or you actually transfer money from your business account to cover, fine. But whatever you do, don't borrow from those trust accounts, right? So fundamentally, what does Fixed do? Fixed fronts money, right? We essentially do rent-based financing on rental properties that are all professionally managed. So we do not do this directly to landlords. It has to be with a third-party manager, right? Where we're essentially willing to cover, repairs, turnovers, light improvements. Our kind of boundaries are up to a third of rent for monthly payback. And so that can like goes into calculation of how much we can ultimately deploy. And we try to stay below 5% of the property's ultimate value, right? In the amount we were willing to deploy. The property does not have to be leased. Of course, we prefer that it's already leased because what we're really doing is we're factoring that lease. Or if like because this happens plenty of times, the property's sitting vacant. We have a term internally called vacant stalled. These are your properties that are sitting vacant. You've called the owner, you've asked them, you've pleaded them, please let us help you. We just need $3,000. And the owner's like, well, I'll get to it. Or they have multiple partners on a deal. And so the owner has to then call their friends or their partners and be like, hey, I need you to contribute 500. I need you to give me a 500. Like, it's just slow. And so whenever that happens, we saw a huge gap in the market of, well, okay, well, what are the current, alternatives? Well, a lot of people will easily say, oh, HELOC. Well, one, HELOCs aren't for investment properties. Two, HELOCs are slow. Three, HELOCs are based on your landlord's credit, not actually the rental, like the performance of the rental property. Okay. And so in those situations where you need money tomorrow, right, to prevent, further issues of the rental property, HELOCs aren't going to work. Your landlord's credit card's not going to work because your vendor's not going to accept his credit card. Like there's just all these issues. And so what we did was we ultimately built what we think is the perfect solution, which is our money's not based on your landlord's credit. We actually underwrite the property management company, not because the property management company is on the hook for the money, but we care if your books are clean. Because if your books are clean and ultimately the trust account, like the properties you manage books are clean, we can pre-underwrite every single property for money. So Tony, if you think back to when you were running a management company, if I literally you gave me every address and I gave you, here's what every single property is pre-qualified for. Without a question, you need $5,000 and we pre-qual for $6,000. You hit the request button and I'll give you the money same day. Right now, that's asterisk, right? Obviously, the owner has to sign things like that. But the point is like this is not your like, oh, we got to go to a bank and submit historical financials and underwrite the owner for their credit. No, this is quite literally like you sign up, we slurp the data, look at historical financials, we run comps on all your properties, and we literally give you a pre-qual. This property we're willing to do 22,000. This property is 15,000. This property, 3,000. You don't have to take it. Doesn't cost you anything to do it, but now you have an option. And that's the biggest thing that we realized, which is most PM companies don't have any other option. Like they call their owner and the owner's like, well, I don't have it. What can we do? And the PM is just like, well, you're the investor. You're
Yeah.
supposed to have the money. Like, what do you mean you're asking me what can we do? And so now, at least with Fixed as a partner, you actually have options. Now, these are always an asterisk. We're not going to guarantee anything, but at least you have something you can say versus go figure it out. Or the property just sits there vacant and nobody's making money.
Well, here's something that I think that hit me that I don't know that everybody thinks about this. So if you have a property that needs that $22,000 to bring it up to current market standards, if you're unable to do that, you have two choices: let it sit vacant or rent it for below market. And if you rent it for below market, the owner loses money and the management company loses money because most management companies are not on a
That's right. It's
fixed
a
fee.
percentage of rent.
They're on a percentage
Yep.
of rent. And so if you think about that, number one, if you're really working hard to do the right thing for your landlord, number one is how do we get this thing leased up? But how do we get it leased up where we're at market rent? And so that's doing right by your client. But also, if you're managing an asset that is an underperforming asset, you're probably attracting underperforming tenants because somebody that's willing to live in a property that has not been well maintained is probably somebody that's used to not maintaining a property. So the cycle just continues to get worse and worse.
Correct.
And you're making less money by doing more and more work as the management company. So I'm going to ask you a little bit about creating this as a profit center, but even if there's nothing there that the management company can do as a profit center by employing something like this, you are still making more money because you're getting that property back on market at a higher rent rate.
That's correct. And you didn't mention that many times when a property goes vacant, stalled, or whatever it may be, the owner's just going to say, sell it. They've now moved in their head from I'm willing to deal with this to I don't want to deal with this anymore, just sell it. And if you're selling when the property is vacant, that's not good, unless it's like a frothy market, fine. But if you're selling for the financials, like the actual cash yield or whatnot, that's not good because there's no cash yield when it's vacant. If you had to lease it because you just couldn't put in any money, you're going to sell it at a discount as well. So just like you said, it just becomes this like snowball effect of bad after bad after bad. And inevitably, you're going to churn that client or you're going to churn that property. So having this available becomes very, very interesting. I can tell you right now, a lot of people immediately go to, okay, well, what is it going to cost? What's the cost of capital? So I'll pose this as a question to you, Tony. What if I told you that to the landlord, it can be like 4%, right? If I told you, Tony, I can give you 4% money for that $22,000, right? As a landlord, what would you say?
I mean, that's cheap money. Do it all day
That's a no
long.
brainer, right? What
Yeah.
about 9%?
Yeah. 9% is still probably better than they can get. I mean, it's way better than putting it on a credit card for sure.
That's correct. And even at 14%, it becomes very interesting. And the reason is because, and a lot of people are like, oh, this product's only for like my like landlords who don't have the cash. And we actually say, no, what's interesting is we've actually found it's the landlords who are rich. They have alternative investments and opportunities for their capital. Would you want to tie your capital up in an illiquid investment like a rental property, right? Where you can really only capture that when you sell the thing? Or would you rather your money keep, compounding in S&P? Because think about it, if you were to sell your stock, right, you've now got to pay best case long-term capital gains. That's a 15% right there that you get hit with, let alone the cost of capital of whatever other financing that you could potentially get. So coming to somebody and saying, hey, look, it's 14%, not saying ours is, but let's just say it's 14%. The landlords who are savvy are be like, wait, no credit check? And it's really just, I just sign here and I get the money? They'll like what we found is they'll do that all day long as well. Like you as a property manager, it's not your job to determine if this cost is good for your landlord or not. You should really just focus on let's give them options and let them decide. And again, the big thing that we differentiate ourselves with is its speed. Quite literally, like we've deployed funds same day, right? We're able to make decisions within 5 minutes of receiving a request because we've already pre-underwritten the vast majority of the properties that we see. Tony, I wanted to go into one other topic related to Fix, but I'm happy to go wherever you want to go first.
Okay, so really quick, because you threw out the number 14%, so I'm thinking that might be what sticks in people's mind. So how do you determine the pricing? Is it different based on the portfolio? Is it based on cash flow? And we don't need to spend a lot of time on that, but just I want to know, so people that are interested in this, what do they need to know to reach out to you and how to engage with you around that?
Yeah. So the cost of capital, it's less about it's less about like it's 100% less about the landlord's credit. We don't even check landlord credit. Okay. Like how are you going to check credit on an LLC anyways? Okay. So we don't check landlord credit. Secondly, we care about the viability of the property management business because inevitably when we deploy the money, like our biggest risk is that the PM company either loses the money, they go out of business or whatever because we've now lost our local partner who's the one who's ultimately collecting rent to pay us back. So we care a lot more about the PM than the actual landlord. Now, of course, the property itself, but again, we have guardrails around like what we're willing, yeah, like what we're able to essentially deploy to a property. There's guardrails around like the equity in that property and things like that. So the biggest factor on cost of capital to the what the landlord actually sees is discounts from vendors. And this is a very interesting thing that we've borrowed from buy now, pay later, right? And merchant cash advance and equipment leasing companies, which are massive, right? These are massive industries. And what we found is ultimately your vendor, your electrician, your plumber, your GC, they will gladly take a 10% discount when they know they're going to be paid when the work is done, right? When they come in to any company, homeowner or property management company, and they're like, I don't know if I'm going to get paid the whole thing when I finish, right? Like they're all also underwriting essentially or increasing their cost or doing whatever to be like, okay, let's add some buffer just in case here. But when they know that fix is like there's a contract and we're going to pay this, and if anything, we've already moved the money to the PM's trust account and it's ready, and all they have to do is finish the job. The PM goes, gets eyes on it. Yes, confirmed, and they pay. We've seen time and time again, vendors are willing to give 10, 15, even 20% discounts on their invoices because they know they're going to get paid. And ultimately, they're trading. I'm giving a smaller discount to guarantee payment, but I'm also increasing volume of work because now the PM also is like, oh, Onyx Plumbing is amazing. Every plumbing job, I want to work with Onyx because I also know that we can offer a better financing package to our landlords at 4% or 9%, which is better money than they can get anywhere else. Right. And so that becomes this fortuitous cycle that becomes super, super interesting. The PM doesn't, again, remember, PM holds no liability in any of these, right? They just have to keep doing their job, which is collect rent, manage the property, right? And inevitably, we've actually seen PMs mark up, right? So the PMs will actually take 5% themselves, right? Or 2% or whatever it is, on top of the increase in management fees they're going to get because rent has increased as well, right? So
And that's not a last point. So that was the revenue stream that I was talking about. If you could figure out how to bring this program into a portfolio of, and just to keep the math easy, 100 doors, a percentage of those are going to say, okay, well, I wasn't planning on upgrading my property at this point because cash flow's tight, but I can see how replacing that worn out 5-year-old carpet at turn with more quality flooring, that can increase my rent rate, so I can wind up getting that paid back to me over time because I'm actually increasing the value of the home. And so as a property manager, that's a lot of work if there's no juice in the squeeze
correct.
for the property manager. But if there is a way to create a little bit of extra juice from a property management standpoint, now all of a sudden this becomes one of my favorite tools of now I'm increasing the value of the property, getting more rent, and I'm providing a service where, I always say I am not somebody that wants to fee max my clients to death, but I am somebody who looks for ways to provide value and then to be appropriately compensated for the value that I deliver.
That's correct. And what's beautiful about this model is if we can help you increase rents, again, because most management companies are not flat fee based, they're percentages based. Whatever you increase the rent by, you've ultimately also automatically increased your management fee by. And it tends to be a win-win-win all across the board. Yeah.
All right, Taylor, you mentioned you had one more topic, and so let's give you space to address that.
So we have a second product at Fix. I'm sure plenty of you guys have seen or heard of Flex Rent, right? Or it used to be called Best Egg if you were on Appfolio. It's essentially giving your tenants the ability to have flexible rent payments, right? But what those companies have done is they've come and they market directly to your tenants and they cut the management company out of the loop. So ultimately, your tenant goes to them, pays them $14.95, call it $15 a month for the ability to flex their rent. They then do that ability, the flex rents of the best eggs, then front you all of the rent on time. And as a management company, you lose the data on whether or not your tenants are actually good or not, because you have no clue if they're paying late, if they're splitting it. You have no clue because you're essentially seeing, oh, all $1,500 plopped in on the first or on the fifth or whatever it may be. So one, you've lost now the data. You've also lost your late fee revenue, but you're still being bucketed as you're the old property manager that doesn't have any options. You just want to be the slumlord that collects the 10% late fee effectively and $5 extra every day that you're late. And as we've seen, more and more regulators, state level as well as federally, are coming after effectively managers. And the most recent one, I think, I forgot who posted, maybe it was Peter Lohman, but it was like, everyone is looking at management companies because a bigger and bigger portion of the voting population are renters now, right? And so it's getting more and more political, support. So, or attention. So one of the programs that we've now developed or products we developed is essentially flex rent or on-time rent as we call it, but we power it through the property manager. So now as the property manager, you can go to your tenants and offer a flexible rent program. You actually pick what you want to charge, but let's just use the same numbers, $15 a month to be able to split your rent into two. First, half on the first, half on the 15th. We as fixed, we front you essentially all of the rent as of either the first or, on the, right before it's late, right? That way your cash flow as a management company is consistent, it's reliable, and ultimately you can pay your vendors and your owners on time every time, regardless of if your tenant needs a little bit more flexibility, right? If they're late or whatnot, and you haven't given up not necessarily all of your late fee revenue, but at least you're offering, it looks a lot better. You're the one offering the solution now. You look like the good guy, and inevitably you get recurring revenue versus one-time late fees. And so, Tony, we talked about in this, I'm going to bring this back to like acquisitions and selling, right? Or valuing a PM company. Because I've done this multiple times and because we've also done this for like, we were the, due diligence for other people buying. Whenever a management company, you look at or you look to value a management company, you typically take one-time revenues, like, for example, maintenance markups, leasing commissions, application fees, things like that are one time that you can't really consider like it's going to happen every single month. We typically mark those down to almost zero. We give like zero multiple for that kind of revenue. But recurring management fee revenue, there's a big multiple on that. And so when you can shift late fee revenue to a monthly recurring flexible rent program where you're getting it consistently every single month, whether they use it or not, that tends to give you a much higher multiple and ultimately a valuation than one-time late fees, which again, if you've ever bought or sold a management company, you look at the late fee revenue, you're like, yeah, that's like worth zero. Because I have no clue if that's going to keep happening or not next month or 2 years in the future. So that's another product. Very, very interesting. Solves a lot of problems for management companies. And reaching out, look, we're doing this the unscalable way right now, right? If you're interested in anything we're doing when it comes to either accounting as well, but also financing, cash flow problems of management companies, you're more than welcome to reach out to me. I'm everywhere at Taylor HOU, right? Or you can just email me. My emails are always the same. First name Taylor at whatever company it is, right? Whether it's fixed, FYXED.com, APM help, right? And if you want to talk robots, you can find me as well.
All right. Well, Taylor, it's been a pleasure having you on. The topic of money and finance. People talk about how do I grow my management company, or how do I automate my processes, or how do I do all of these things. But the topic of money, I don't know why, but it doesn't get the attention that it deserves in our industry, because you can make a lot of money, but if you're spending a lot of money or you're not able to cash flow, like the whole basis of having a good business is knowing and understanding where the money's going, where it's at, and then having that bridge to help when you have cash flow issues. So all of the information you shared with us today was really insightful. So any last words that you want to share as we wrap up?
I'll share this one last thing. We went through the ZIRP era, the zero interest rate period, where there were these quote unquote nationwide property management companies that are coming in. They raised venture capital. They started paying arguably ridiculous prices for what ultimately became management contracts. I think we saw things as high as like 4,000, 4,500 for a 1 year management contract. And ultimately like those contracts may or may not have stayed. And they paid like 5 years for, one contract kind of thing. So because of the wave of AI, we're seeing some initial signs that another wave is coming. Now, this doesn't mean you all go get ready to sell, right? Like it's selling season again or whatever. Like, no, but it's like if you're a really good operator and you're working on your business, I can tell you, and this comes full circle back to what we said earlier about like management or middle management ultimately eroding your the cash flow profitability of your business. What we're finding and seeing is with AI, if you're able to leverage it well, you're able to ultimately accrete more to the bottom line without adding headcount. Okay. And yes, of course, everyone's gonna be like, they're gonna start immediately thinking about like, oh, AI receptionists and oh, AI leasing agents and AI maintenance coordination. Yes, fine. That's fine. But right now, we're also thinking just in general, everything is moving towards AI agents. And so your systems and processes have to be tight. Your data's got to be flowing, and these are all problems in our industry. Like there's management software, and then your leasing software, and then your maintenance thing. Like everything doesn't talk to each other. AI and agents today are making it so that I would argue in the next year or so, you're probably going to find some companies that come out of the woodworks that you've never heard of. Um, that are going to have some pretty bold claims where they're effectively going to say something along the lines of, we're able to now do property management with zero humans outside of, let's say, obviously your necessary boots on the ground people and like the owner, but you're going to see some very interesting stuff happening. And with that will come an appetite from investors, private equity, who are now looking at traditional old service businesses and saying, huh, if we can just accrete an extra 10 or 15% to the bottom line, we can take a traditionally not profitable industry like property management, who on average is only 8%, and we can make it look like a rock star industry at 20%. And if that happens, we're going to see another wave of buying. And ultimately, like, yeah, there's going to be some big change. And hopefully some of that change sticks. But that's going to be a big boon for our industry as well. So look out for it. If you're 65, hold on. Like in the next 5 years, you'll probably be able to have another opportunity. But if you're 30 or 40 and you've got another 20 years in this business, like get along for the ride because it's going to be really, really interesting over the next couple of years.
All right, well, that's a really good prediction, and I don't know where the business is going to be in 3 to 5 years, but I know it's not going to look anything like it looks now. And so I'll have you back on, and we can talk about looking back maybe 12 to 24 months, what just happened, and see if these predictions came true.
Very good. Thanks,
All
Tony.
right,
Thanks for having me.
thanks, there.